In this presentation, we will take a look at the audit process related to retained earnings and dividends. Now, when we consider retained earnings, note that we're thinking about the balance sheet. We're in the equity section, and specifically, we are in retained earnings. What is retained earnings? It's going to be that account that's the accumulation of earnings over time. So whenever we close out, in essence, the income statement, the net income, you'll recall, is going to be increasing retained earnings, and retained earnings then going up by the net income, down by a loss if the company happened to have a loss, and then it's going to be going down by any dividends that we take out. So when we take the dividends and pay the earnings that have been retained from the company for the income that's accumulated over time and been accumulated in the account of retained earnings, we then pay it to the owners at some point, hopefully in the form of dividends. And the dividends then, of course, are kind of like draws, and they would be, for a sole proprietor, they would be draws, kind of like draws for a sole proprietor, although they're going to go through some more bureaucratic process in order to have the dividends, and they're taxable. But in any case, in their draws are like draws in that they will be decreasing the retained earnings. So given that, note that retained earnings shouldn't have a lot of transactions to it, because, I mean, if it's nothing unusual happened, if it's a really kind of plain normal type of year, then retained earnings should be what it was at the end of last year. Nothing should happen to it except for some dividends should be taken out of it, which should be a pretty straightforward, not too many transactions with regards to dividends decreasing retained earnings. And then, of course, we have the net income that would roll over to it. So it's really just rolling over retained earnings and then taking out the dividends. That means not many transactions with regards to retained earnings. Typically should be fairly simple to audit. We should be able to basically consider all the transactions that are included in it on more of a kind of a substantive type procedural process. Primary concern with relation to dividends is over violations of corporate bylaws or debt covenants. So any kind of violations of the bylaws is going to be our major concern with regards to the dividends. And recall that the dividends are going to be the items that are leaving. So we're going to be paying out the dividends, which will be reducing the retained earnings. And we're going to be paying them to the owners, the stockholders of the organization. So they're going to be retained earnings increases. We're going to pay them out in the form of dividends. Dividends being the earnings that have accumulated over time that we're distributing to the owners being the stockholders. If an independent dividend dispersing agent is used, the auditor will confirm the amount dispersed with the agent. The amount is then agreed with the amount authorized by the board of directors. So once again, if it's a publicly traded company, we have this basic bureaucratic kind of process, third-party individual that we can really use within the auditing process, which is kind of the function of it or part of it, that we can go to and confirm these transactions with. So if an independent dividend disbursement agent is used, kind of like a third-party individual, outside, not directly connected to the company, therefore good audit evidence to go talk to that individual, audit will confirm the amount dispersed with the agent. The amount is then agreed with the amount authorized by the board of directors. If an independent agent is not used, however, what if we don't have that independent agent? And if it's a publicly traded company, you would think you probably would. If it's not a publicly traded company, then it's quite possible we do not. In that case, auditor will recompute the amount of the dividend authorized by the board of directors. So note, when we have the dividends, it's one of those kind of key issues that should be authorized by the board of directors. And then, therefore, we can go through the authorization process to make sure that the dividend process was properly authorized, and we can recompute what was authorized by the board of directors. So we can then the amount of dividends authorized by the board of directors and trace the amount to the cash disbursements or dividends payable. So then, of course, we'll take that recalculation and trace it out to what actually happened. Now we're going to consider retained earnings. So that's going to be the accumulation of the net income minus the disbursements, the dividends. Retained earnings are generally affected by the current year's income or loss and the dividends declared and or paid. Now note, when we consider the dividends, that's going to be an important point when we consider the valuation of retained earnings, because remember, there's basically 3 time periods that you have a dividend. You declare the dividend, and then you have a point in time basically when the people that are holding the dividends, that's who's going to get the dividends, and then you pay the dividends. And the 2 important points from a financial accounting standpoint is when should we record the dividend? Even though it's not paid, we typically record it when it's declared. So then we're going to record it when it's declared, meaning we have a dividend that's going to be a debit, and then we're going to credit like a liability, just dividends payable. Why? Because we've committed, or the company has committed to giving a dividend. Therefore, we're going to reduce the retained earnings. We're going to show a dividend in the equity section, and we're going to show that that company has a liability because they have to the shareholders, because they have declared that they will indeed give that dividend. Then, of course, they'll pay the dividend at a later point in time, at which point they will credit cash, decrease in cash, and reduce the dividend payable liability account. Now, again, that's basically it with regards to retained earnings. It's a really important account, but really it's basically the net income that's going to roll into it, or the loss, and the dividends. We talked about the auditing process of the dividends, and with regards to the net income, of course, we will audit net income, but we're going to audit net income as we audit basically the income statement accounts. And notice even the income statement accounts, as we'll discuss in future presentations, much of the auditing of the income statement actually happens as we audit the accounts on the balance sheet and the processes related to them, because as we think about the processes, we think about the related accounts that will be both income statement and balance sheet accounts. And as we audit things on the balance sheet and consider the processes as we do so, we typically do a lot of auditing on the income statement as well. So in other words, with regards to retained earnings, the net income will roll in, which comes from the income statement. We're going to audit basically the income statement to get to the net income statement. And so we're not going to spend a lot of time thinking about that transaction with regards to retained earnings, because we'll be auditing and thinking about it in terms of the income statement. So obviously we're going to tie out and make sure that the net income that's recorded, closed out, and reported in the books ties out to the income statement, that basically being taken care of, hopefully by just simply the double entry accounting system. If that wasn't the case, we wouldn't be in balance. And then we have the other types of transactions, however, that could affect retained earnings. If they are present, we would want to be concerned with them and look into them. So prior period adjustments. So if there were any like prior period adjustments that got recorded to retained earnings, in other words, like if there was an adjustment in the prior period and we made it this year, then that adjustment is going to be something that's going to roll into basically retained earnings. It's going to affect retained earnings because it was in the prior period, and the prior period was closed out to retained earnings, and then we adjusted it. So now there's going to be some kind of adjustment to retained earnings. A correction of an error, that's another thing that could possibly happen. Like if there was an error, then and it got corrected, then if some period was closed out already, the adjustment might go to retained earnings if we had to, depending on how we correct that error. So, for example, I mean, if you canceled a check in the prior time period, and the check was going to an expense account, and we said that was an error, and then we adjusted it, of course, and that expense account was rolled over to retained earnings, then it could affect basically the retained earning account. So we're going to check that item, and then the stock retirements. So any kind of stock retirements, that transaction happens, we'll check those items. Now note, in publicly traded companies, we would expect retained earnings to basically be accounted for, to roll forward. If there's any kind of adjustments with these items, then they would basically be accounted for, and we can look into them and test them. If we're talking about smaller companies and you're talking about a review or something like that, the first thing we're probably going to do is check that retained earnings does indeed tie out, meaning does the beginning retained earnings match what was on last year's financial statement. So last year's ending retained earnings should be the beginning balance in the retained earnings account in the general ledger for the current year. And then any transactions that happened, you would think would only be things like dividends that would be decreasing it, and the net income at the end of the year. The first thing you want to do in a smaller audit is check to make sure that is indeed the case. And if it's not, then it could be the case that some kind of prior period adjustment happened, some kind of adjustment happened that adjusted the books in the prior period and then rolled out to the retained earnings. So now retained earnings doesn't tie out as it should. And if that's the case, then you got to go back and think about try to dig through and figure out what happened. And the easiest way to do that is to basically line up the balance sheet accounts as they are in the current system for the beginning of the time period or the end of last time period, and try to match that up to the audited financial statements or the completed financial statement or reviewed financial statements in the prior time period. And then you can match those up and take the difference and see where the differences are and which accounts are off. And then you can go back and see what kind of prior period adjustment happened and whether or not it is correct. So again, in publicly traded companies, we would expect retained earnings to roll forward, to be taken care of. And then if any adjustments in there, we just take a look at the transactions and make sure that's the case. In small companies, if you're working with small companies for reviews or something like that, or even tax returns, then that's probably checking that retained earnings rolled forward correctly is one of the first things you probably want to look at. And then you want to consider if there were any prior period adjustments that were made either correctly or incorrectly, and look into that. And the best way to do that is to match up the balance sheet accounts as of the end of last year to what's currently in the system, hopefully as of the end of last year if you have it, and then you can see what the differences are.